Welcome back. In this lesson, we shall learn the various kinds of instructions a trader can specify when placing a market order. They can be classified as execution instructions, validity instructions, and clearing instructions. Those of you who trade frequently in the stock market may find some of these terms rather familiar. Let's get rolling. We discussed about dealers earlier. Unlike brokers, which facilitate the transaction between the buyer and the seller, dealers buy and sell securities directly from the traders and primarily profit from the spread between the price they buy at, known as the bid, and the prices they sell at, known as the ask. This difference between the bid and ask prices is referred to as the bid-ask spread. Often, the bid and ask are quoted for specific trade sizes. Larger size trades often have narrower bid-ask spreads. Besides, more liquid securities have lower bid-ask spreads and therefore have lower transaction costs for investors. In a market, there can be several dealers. The quotation in the market is the highest bid and lowest ask from among all dealers in a particular security. Traders who post bids and offers are said to make a market, while those who trade with them at posted prices are said to take the market. When investors want to trade, they must enter orders that specify whether to buy or sell and the size of the trade. The order can also include execution instructions that specify how to trade, validity instructions that specify when the order can be executed, and clearing instructions that specify how to settle the trade. Let's look at each of these instructions. Execution instructions specify how to trade. The most common are market orders and limit orders. A market order instructs the broker to execute the trade immediately at the best possible price. A limit order places a minimum execution price on sell orders and a maximum execution price on buy orders. For example, Margaret issues a market order to buy 4 shares while Lee issues a limit order to buy 4 shares with a limit price of $233. If this is the sell queue when the orders were made, Margaret will have all 4 shares filled immediately based on the best prices that are in the queue. For Lee's order, only the best ask is below the limit price of $233. Therefore, only one of the 4 slots will be filled at this instance. A market order is often appropriate when the trader wants to execute quickly, as when the trader has information she believes is not yet reflected in market prices. However, as you can observe, this order caused Margaret to buy 1 share at a very high price. Such is the trade-off in return for immediate liquidity. Price uncertainty is the biggest shortcoming of market orders, especially if the security has low trading volume relative to the order size. Compare this to Lee's limit order at $233. This removes price uncertainty, and Lee is assured that if his order gets filled, the prices will be at the limit price or better. The disadvantage, however, is that the order might not be filled or only be partially filled. As in Lee's case, his order was only partially filled. If the stock price rises over time, he would have missed out on some of the gains. Some terminology with regards to limit orders. A limit buy order above the best ask or a limit sell order below the best bid are said to be marketable or aggressively priced because at least part of the order is likely to execute immediately. If the limit price is between the best bid and the best ask, a limit order is said to be making a new market or inside the market. Limit orders waiting to execute are called standing limit orders. A limit buy order at the best bid or a limit sell order at the best ask are said to make the market. Again, the order might not be filled. A buy order with a limit price below the best bid or a sell order with a limit price above the best ask is said to be behind the market. It will likely not execute until security prices move toward the limit price. A limit buy order with a price considerably lower than the best bid or a limit sell order with a price significantly higher than the best ask is said to be far from the market. Besides market versus limit orders, which specifies the price limit of the trade, Traders can also specify the volume of the trade. If there's no specification, the broker makes a best effort attempt to fill as many units before the order expires. If the trade specifies an all or nothing order, the broker executes only if the whole order can be filled. So for Lee's order, his entire order for 4 shares will not be filled as not all the units can be filled. Traders can also specify the minimum size of a trade. The trade only executes if the minimum size can be met. For Lee's order, if he specifies a minimum of 2 shares for the trade to execute, the trade will not execute until there are at least 2 shares in the queue that meet his limit requirement. This type of order is beneficial when trading costs depend on the number of executed trades rather than the size of the order. Trade visibility can also be specified. Investors that have a large amount to trade and do not want to reveal their intentions prefer hidden orders, for which only the broker or exchange know the trade size. Traders can also specify display size, where some of the trade is visible to the market but the rest is not. These are also referred to as iceberg orders because part or most of the order is hidden from view. They allow the investor to advertise some of the trade without revealing the actual size of the trade. This can be a way to estimate the liquidity of or buying interest in the security. Traders can also specify the validity of the order, that is, when an order should be executed. Most orders are day orders, meaning they expire if unfulfilled by the end of the trading day. Good till cancelled orders last until they are filled or when the trader cancels the order. Immediate or cancel orders are cancelled unless they can be filled immediately. They're also known as fill or kill orders. Good on close orders are only filled at the end of the trading day. If they are market orders, they're referred to as market on close orders. These are often used by mutual funds because their portfolios are valued using closing prices. There are also good on open orders, though not as common. Stop orders are those that execute only when the stop price has been met. They're often referred to as stop-loss orders because they can be used to prevent losses or to protect profits. Suppose an investor purchases a stock for $100. If he wants to limit his loss to 20%, he can enter a stop-sell order at $80. If the stock trades down to $80 or lower, this triggers a market order to sell. As we've learned earlier, there are no price limits on a market order. If the stock price is rapidly falling when the stop-sell order was triggered, then the stock could be sold at a price significantly lower than $80. A stop buy is the opposite of a stop sell, where a market buy order is triggered when the stock price rises to or beyond the stop price. A trader with a short position could issue this instruction to limit losses from an increasing stock price. Other than short sellers, an investor who believes that a stock is undervalued but does not wish to own it until there are signs that market participants are buying may place a stop buy order. The investor is betting that the buying momentum will continue. Likewise, if the stock price rises too fast, the actual execution price may be higher than the stop price set by the trader. And let's conclude this lesson with clearing instructions. Clearing instructions are usually standing instructions by the client and not attached to an order. Such instructions specify how the trade is to be cleared and settled. Retail trades are typically cleared and settled by the same broker who arranged the trade. Institutional trades may be settled by a custodian or another broker, which might be the trader's prime broker. Using 2 brokers allows the investor to keep one broker as the prime broker for margin and custodial services, while it engages other brokers for specialized arrangements. When a trader issues a sell order, one important clearing instruction is to specify whether it is a long sale or short sale. For a long sale, the broker must confirm that the securities held are available for delivery. If it is a short sale, the broker must either borrow the security on behalf of the client or confirm that the client can borrow the security. That concludes this lesson on order instructions. In our next lesson, we shall learn the difference between the primary and secondary markets. See you soon.